My goal is to give you the timely insights and tips to help you master the game of finance and ultimately help you achieve your financial goals. Hello, my name is Connie from Prosperity Finance. Now, recently we published an article and video about in the special lending policy for small property developments. Now, this attracted a lot of people's inquiries. Today, I'm going to cover a very similar topic, but this time is for prior to construction loan, what you need to be aware of. And this is normally the area that people normally not pay attention to. And as a result, it can create some problem down the track. So today I'm going to talk about pre-construction loan. Now I'm going to divide into two parts. One is for people who already own the property that subject to developments. And the second part is for people who need to purchase the property and then develop straight away. So let's start with the existing ownership. So you may have a property that you purchased a few years ago as investments or as a home, and now there's good opportunity to develop, and then you can create extra cash flow, or maybe you want to sell to have some cash in hands. So with existing property, you need to make sure that property which to be developed, it's better to be in a standalone banks. If you can't discharge, ideally you keep it discharged, therefore it's mortgage free. But if you can't, maybe because you don't have enough equity, then it's best to keep that property with just one bank, and there's no any other property that mortgaged to the same bank, regardless what the ownership of other property. You probably own the site that to be developed under a different entity from other property ownership, but they are more likely to be cross-secured anyway. So it's best to keep them separate. If you don't do that, normally the consequences, number one is the construction. When we get to the construction stage, you may not be able to meet the criteria for loan to value ratio because you have a lot of loans. Therefore, that stop you from getting the construction loan. Now, the second downside is there will be a larger finance cost. Instead of just financing one small loan, you end up have to take all the property that from the same bank to the new lender for construction loan. And if you borrow from a finance company, the finance cost will be really, really large. Now, the last point is about asset protection. You don't really want the property development loan has anything to do with the other property. If anything goes wrong, which is possible, with the property developments, there's always risks. You don't want to, ruin other property, right? So always keep them separate if you can. And you need to do it well in advance, well before the construction loan. So this part is about reviewing the existing, finance structure and make sure the property that you're going to develop is not in the same bank as your properties. So now let's move on to the second part, which is for people who need to purchase the property that has the development potential. So firstly, I recommend that you do a good due diligence and make sure you understand different options of the design and what the rough cost under each design and what is the project margin for that. What I noticed that a lot of people who purchased a property and looking to develop straight away, there was very little margin for the project, and therefore they may not proceed to development straight away, have to land bank it for a few years until the finished value have a big increase to generate a higher margin. The small margin not only affect the application outcome, but also very risky for yourself. There are some costs that you may not be able to define in the early stage. So even with the quantified costs, it's already a small margin. If there's a cost overrun, you may end up losing money. So not every project is feasible straight away. So you need to do your due diligence really well. And if you already purchased the property and then realize it's not going to be developed straight away, and you don't qualify for the bank lending, that's going to be a huge cost for you to hold that property in the long run. So the pre-purchase part is super, super important. Now let's talk about the finance option for property that you want to buy for future developments. So you could consider banks and non-banks. So what is the difference between the two? Now, that depends a lot of a criteria. Number one is if the entity is GST registered. Let's say you want to purchase the property under a company, then you need to declare if the company is GST registered or not. If it's yes, then the banks will know it's going to be used for development, because normally you buy a rental property, there's no GST attached. The second point is about usable equity. You may have GST registered for the property that you're going to develop, but you have equity in other property that you can use to top up, and the funds will be used for settle the property. So that's okay with the banks as well. And then we'll also look at the servicing ability. If your income cannot service the loan, then bank definitely wouldn't consider. We have to look at the non-bank option. And then it's about ownership structure. Are you going to purchase by yourself or with your family members, or you're looking to purchase with your business partners? If you're looking to purchase with a business partner, it's very unlikely to borrow from the bank, because the way that bank assess your servicing ability with your business partner is quite different from you borrow from with your family members. They're going to test each applicant if they are able to service 100% of the loan, and most of the time it doesn't meet the criteria. And also, because you are a business kind of relationship, you don't really want to provide your personal assets for security. So most of the time, if you want to have a business partner to own the property together, normally it has to be settled with the non-bank lenders. Now let's talk about the non-bank lenders. Now, this part of lending is just to give you time to prepare for the drawings and get the consent ready for construction. It doesn't have to be the same lender as the construction loan lender. Especially after COVID, last year, after first COVID lockdown, a lot of finance companies, they no longer offer construction loan, because there's a great risk with a construction loan. It's going to take a year or 18 months or longer. They're not confident about the market, in such a long period of time. So they're more than happy to do equity release. So what the equity release means is you give them an existing property, and then they will release funds against that property, rather than using a site that for developments and the value increase incrementally as you build. So for the settlements of the new property, ideally you just go with an equity release lender. They are far cheaper than the construction loan lenders, and we can always go to a construction lender later on. So this part is really about getting a cheaper finance to help you settle. Then you need to consider a long-term settlement, because really if you have a long-term settlement, you can use that time to prepare for the consent, etc. That's going to take at least 6 months to a year. So the longer the settlement date, the shorter the finance period before you move on to construction. Now, the ideal kind of time frame is by the time you settle, you already has all the consents and ready to do the construction loan. But most of the time you can't have that luxury of, like a year settlement. But, the longer you can negotiate, the better. Now, in terms of long term, generally is a few months. It's just the period that you need to complete to get all the consents. So you have to estimate how long it's going to take. And normally you need to add a bit buffer to that. There will be some delays than you expected. And also some equity release lenders, their pricing is no different for, say, 6 months and 12 months. So you better ask for 12 months then. It just give you a lot of buffer, and you can give them notice when you want to repay early. If your requested long term is not sufficient, then you have to ask for extension, and it will cost you another set of fee. So it's better to have some buffer when you propose the long term. So the next point is about interest payments. You can pay the interest on a monthly basis, or you can choose to capitalize interest, which means it will be added to the loan. Sometimes you don't have an option. If your servicing is not enough, the lender will require capitalized interest. The downside with capitalized interest is that you will have less money end up for settlement, because a portion of that loan goes to cover interest cost during the long term. And also is interest on interest, so it's not really good, but sometimes it's not an option. In terms of loan to value ratio, LVR, if you can undertake, you're not going to demolish the house during the long term, normally the lender can include the dwelling, the improvement value, when they work out the loan to value ratio, rather than just use a bare land. And also in terms of value, if you are GST registered, then they will take out the GST from the value. Now, 60% LVR is kind of the rule of thumb. You can consider borrow more, like 65 or even 70, but you may scare off some lenders because they don't want to lend this much. And also the finance cost is generally more if you go over 60%, but it is possible for you if you need the extra lending. Now, in terms of exit strategy, is normally the refinance to the construction loan lenders. So you need to work it out. Before you repay, you have to work it out who can lend you the construction loan, and the loan should include the existing lending for settlement. In terms of security, generally speaking, they will take first mortgage over the subject property, and they will also require personal guarantee if you are shareholder, director, or trustee. And they will have a GST over the entity, like a company or trust, just to give them an extra kind of security. Some other tips, if you're looking to buy a property for developments, make sure before you purchase, talk to professionals such as town planner to work out different plans and understand which option is better. And it sometimes depends on your intention. If you want to sell, then the option may be different from keeping them for long run after developments. Also ask real estate agent for advice, because they are dealing with the buyer, day in, day out. They know what the demand from the market, so they may give you some insights, especially want to sell. It's not the higher in density, the better. It's really about what is the demand of the market. And then you talk to the solicitor and accountant and ask to set up the right structure upfront. It will give you less stress if you do it upfront. It can be costly and stressful if you have to change ownership or you didn't plan really well. So it's better to do some good planning upfront. I hope today the content is very useful, especially if you are looking to develop your property or looking to buy a property for developments. These areas is normally kind of ignored by a lot of people. They think construction loan is the most important, but the preparation before the construction is actually, equally important. It helps you protect your assets, it helps you save your money, and also help you to get the construction loan easier. All right, thank you so much. I appreciate your time. If you have any specific question, feel free to get in touch with us. We're more than happy to help you on an individual basis. Thank you so much. Take care. Bye for now.